So today we're going to dive into the specialist finance landscape, and I'm hoping to give you some practical insights on how to fund your property projects more effectively. So whether you're a seasoned developer or a new investor, this session will hopefully equip you with the real-world strategies and how to apply them. So have any of you used bridging finance before, development finance, anything like that? Okay, do you want to come and do this then? So obviously some of this might be new to you, some of it might be stuff you've already covered, but hopefully you'll get something out of this at the end of the session. So the session is going to be structured around 5 key areas. We're going to start by identifying where bridging makes sense. I'm going to walk you through some key product types, including commercial mortgages as well. And I'll share deal structures and case studies that illustrate practical applications. And I'll end with some tips on avoiding delays as well. I find that's really handy if you're starting to get into property as well. Just knowing the potential pitfalls of what could potentially delay your application is usually quite helpful. So what is a bridging loan? So the typical term is usually between 6 to 12 months. You can go up to 24 on non-regulated mortgages. I'll cover a little bit more on that. The rates start from usually around 0.55%. You're very lucky if you get that, usually low loan to values, and up to about 1.25 to 1.5 per month. And your exit from bridging is usually refinance or sale. So a bridging loan is a short-term, interest-only loan, and it typically lasts between 1 to 24 months, designed to bridge a temporary financial gap. So interest is charged monthly as opposed to annually, like a buy-to-let mortgage. The reason being, obviously, if you've got a 12-month term, you flip your property, you get everything done within 6 months, you don't want to be paying the other 6 months worth of interest. You want to get that money back, you want the gross loan on the property to be a lot less than that. So it's just good to have it charged monthly, because even though it's a slightly more expensive finance, in the long run, it does work out to be quite good. So these loans are interest only. Borrowers pay the interest monthly, or sometimes roll it up in the loan. So you can service it on a monthly basis, which means make the monthly payments. A lot of people don't tend to do that on bridging unless they want the maximum loan to value they can get. Most people decide to have it either added to the loan or deducted from the overall loan. So just be aware, if you don't want to pay the monthly interest, always be aware that you might have to have a slightly bigger deposit as a result. And this is always secured against property. So they're always asset-backed with either residential, commercial, or mixed-use property used as security. And they're also open to individuals and companies. So whether the borrower is a homeowner, investor, developer, limited company, SPV, bridging finance can often be tailored to fit as well. So what sets bridging apart is speed and flexibility. Lenders focus less on personal income and affordability and more on the property and the exit strategy, so how the loan will be repaid. Whew. Right, so I'm just going to talk you through some spot and some bridging opportunities, because it always feels a little bit more complicated than it actually is, and so we'll just go through how it can benefit yourselves. So bridging finance really comes into its own when speed or flexibility is essential. So situations where traditional lenders either can't move fast enough or simply won't lend. So let's walk through some classic scenarios where bridging loans can be an ideal solution. So broken chains. A common one. So a buyer's ready to move, but their own sale falls through. I'm sure some of you have had something similar happen to yourselves. But bridging loan will just step in to complete the purchase while they work on selling their property. Downsizing, so homeowners want to buy a smaller home but haven't yet sold their existing one, can use bridging finance to make the move without waiting, helping them avoid temporary rentals or missing out on the perfect property as well. A big one are mortgageable properties. So if a property lacks a kitchen, bathroom, or is otherwise not habitable, it won't qualify for a traditional mortgage. A bridging loan can fund the purchase and renovation, making the property mortgageable down the line. Renovation or conversion projects. So it's perfect for funding light or heavy refurbishments, especially where the borrower plans to refinance or sell once the works are complete. And lease extensions. If a lease is dropped below the 70 to 80 year mark, many lenders just won't touch it with a barge pole. So bridging finance can help fund the lease extension, so you can get the additional on top. And then once the property becomes mortgageable again, usually with increased value, then obviously you can look to get it refinanced. Planning permissions, when a borrower wants to buy a site or building and add value through planning gain, bridging can fund the purchase and cover costs while permission is obtained. And a big one, this is what I do a lot of, auction purchases. Probably one of the most time-sensitive examples. Buyers often only just have 28 days to complete. Quite often, they'll put the non-refundable deposit down. I get a call from them 10 days later, and they go, right, I've got 10 days to complete. What can you do for me? Swear down the phone a lot. And but the bridging loan usually allows them to move quickly, secure the deal, and then we can look at refinancing or selling it later on. So in short, bridging loans unlock opportunities where speed, flexibility, or creative structuring is the key to making a deal happen. Right, so bridging mechanics. The structure of a bridging loan can vary depending on the deal. So I'm going to break down a few mechanics. So you've got first and second charges. So most bridging loans are first charge, meaning the lender has primary security over the property. But second charge bridging can be useful where there's already a mortgage in place. It allows borrowers to unlock equity without disturbing their existing finance. And not only that, if you sometimes fall a little bit short and you're grossing out at 75% on this, a lot of lenders will actually allow you to get a second charge on another property you might have. So you don't have to get a higher deposit. You can actually do a cross charge across multiple properties that you have by way of a second charge. So you've got regulated versus unregulated. Whether a bridge is regulated depends on who occupies the property. If it's the borrower or close family member living there, the loan falls under the FCA regulation. If it's an investment or business property with no owner occupancy, it's usually unregulated, which gives more flexibility on the terms as well. And as I did just cover this a little bit, but retained versus rolled up interest. With retained interest, the lender calculates the interest up front and includes it within the loan. So as I said, there's no monthly payments. With rolled interest, the interest accrues over the term and is added to the loan balance at the end. So for example, you'll start off with, say, 0.55 month 1, 0.55 month 2, but it will roll up. So it'll be 0.55 times the 2, then times the 3 months, then times the 4 months. So it will roll it up for the duration of the bridge. So both methods reduce monthly cash flow pressure, which is a really big reason for that bridging is such an attractive proposition for many property investors and developers as well. And the big one, obviously the reason we're all here, speed. One of the biggest advantages of bridging is how quickly the funds can be arranged. In the right circumstances, deal can complete in just a few days. You've just got to make sure everyone involved is motivated. They want to get the deal done. If you've got one person letting the chain down, it's game over because everyone needs to have the same goal in mind. And it is far faster than a traditional mortgage, hopefully if you choose the right bridging lender. So I'm going to talk you through this bridging case study that I've done very recently. And it's a classic property flip scenario. Can everyone see the... Yep, lovely. So we supported an investor who purchased a rundown property using a bridging loan. The property was unmortgageable in its original state, so traditional finance just wasn't an option. They carried out a light refurbishment, so no kitchen, bathroom, cosmetic updates, and it added significant value in a very short time. Once the renovations were complete, they sold the property, repaid the bridging loan from the sale proceeds, and then kept the profit. It's a great example of how bridging allows investors to act quickly, unlock value, and turn around deals efficiently as well. Sorry. And so we've got an auction purchase. So this case study highlights how bridging fits perfectly into the auction process. The client secured the property at auction by paying the 10% deposit on the day, as required, but only had 28 days to complete. A traditional mortgage wouldn't have been arranged in time. Please ignore any broker that tells you to just sling it in. But this lender's quite quick. They can usually get it done within a month. Do not do it. You'll waste your money on your valuation fees, your application fees. It's not worth it. These lenders are designed to help you get your finance quick. So they had 28 days to complete. We arranged a bridging loan to fund the remaining 90%, allowing them to complete within the deadline. Once the purchase was complete, the client refinanced onto a buy-to-let mortgage using the rental income to service the long-term debt. This is textbook use of bridging. It's fast, flexible, and structured around the timing demands of the deal as well. And then finally, as I mentioned, a lease extension. So these are really beneficial. So for anyone that likes to pick up property, if you see something slightly undervalued because of the lease extension, go and find a bridging lender because the clients will purchase with a short lease. It makes it unmortgageable through conventional lenders. But you can arrange a bridging loan to not only fund the purchase, but cover the cost of the lease extension. So you can get it either on a drawdown facility, you can have it factored into the initial loan. And what that does, though, is it shows the lender that it's going to immediately have an increase in value as soon as that's been approved. And it's something that many bridging lenders are open to, provided there's a clear exit potential. Oh, there we go. So once the lease was extended, the property value increased significantly. The client then exited the bridge by selling the property for a large profit, though right refinancing would have also been a great option. This is another example of how bridging can unlock hidden value in properties that most mainstream lenders will not touch.
Before we move on, real quick, sorry.
Yes?
On the flip case study.
Yep.
I suppose the question if it is, forgive me, but so you're saying the finance was 75% loan to value for purchase plus refurb. So in theory, they've covered 90k of the purchase.
Yep.
And value of the refurb as well.
Yep, so...
That person's put in 30 grand, that's all they put in.
Yeah, so as usually what it's done though, so you still should have some funds in the background, because what a lot of lenders will do is they'll do a drawdown facility. So you might have to complete some of the works first, and then what you'll do is you'll send your invoice across to the lender, they'll reimburse you in full. So you have like a development tranche.
So for example, you do the kitchen, they'll be like, here's the invoice.
Yep, here's the invoice, I want my money for it. And some of them will have, you can have up to 4 drawdowns. So some people tend to get a fair bit amount of work done and then send their invoices in. Some people need everything done.
75% loan to value up front to get the purchase across the line.
Well, that'd be gross, but yes, that would be. And then, yep, you've got all as much as you need.
Would you get anything up front from that? Or would you basically
Sometimes.
start the work yourself?
So what you can do now is there's some lenders that will give you up to 90% on day one, but then won't fund the works. So you can tend to get a larger amount on day one, but you won't get everything funded. Or you can do 100% of your refurb costs, but you would be limited to maybe 65, 70% on your day one. Exactly. Yeah, I've literally, so someone purchased a property for 500,000 and got 500,000 pounds in a transfer facility as well, because the GDV is going to be about 1.5. So yeah, as I say, sometimes the works will be even more than the property is.
For example, if you had like, sorry.
No, please do. It makes my life easier.
Houses around you at Lincoln, you can get like a terrace for like 100 grand, for example.
Yeah.
If you had 50 grand sat there,
Yep.
and you paid 50% loan to value, could you get your refund basically covered up front with that deal or not?
So there's no point necessarily doing it like that, because you might as well just pull out maximum you can on day one anyway, and then keep the funds for your refurbishment, if that makes sense. So yeah.
Let's borrow it and then.
Yeah, because either way, you're still basically using the same funds. Yeah, so, but yeah, as I say, it's usually, you can, some lenders you can go quite high on your loan to value and still get 100%. But depending on the lender, some of them might say you can get 75% your refurb costs done, or they might cap it. But that's why it's worth having a broker. So if you've got anything like that, you can crunch the numbers and they can go, right, this is going to get you the maximum you can on day one, or what's more important to you, getting the funds for the refurbishment. Does that answer it? Yeah, good. No, I appreciate it. So we're going to look at how bridging often fits into longer term investment strategies like buy to let and buy, refurb, refinance. So with BRR, the typical flow is buy a property using a bridging loan, believe it or not, refurbish it to add value and improve rentability, and then refinance onto a long-term buy to let mortgage once the works are complete and the property is mortgageable. Oh, here's one I did earlier. So this strategy allows investors to recycle their capital and move on to the next project. When it comes to affordability, buy-to-let lenders assess the loan based on the rental income the property can generate. It's not based on the borrower's personal income. That makes it especially attractive for full-time investors, much like some of yourselves, limited companies, or those with complex income structures. It's a really powerful approach for building a portfolio, and bridging often plays a crucial role in getting the first step done quickly. That being said, some lenders do still have a minimum income requirement. It's just part of their criteria. It doesn't really impact how much you can borrow, even though this isn't factored into the affordability. The only exception is top slicing. Some of you may have heard that before, but that is where you can use some of your personal income to top up if the rental isn't sufficient. Oh, the case, there we go. So this case study shows the BRR strategy in action. This investor purchased a rundown property using bridging finance. The condition of the home meant a standard mortgage wasn't an option, as before. Carried out the refurbishment, adding both value and rental appeal as well. So a new kitchen, bathroom, and general redecoration. Quite often these will be referred to as light refurbishments, so there will be anything that's cosmetic. Anything that requires structural changes, planning permission, anything like that, immediately you're on your heavy refurb products, and that's where things get a little bit more expensive, but it means you've got the right product for your circumstances. So once the works were complete, the property was revalued at a higher figure. This allowed them to refinance onto a buy-to-let mortgage using the new valuation to pull out a portion of their equity. That released capital for their next project, while the rental income comfortably covered the new buy-to-let mortgage payments. Once again, another really great example of how bridging finance acts as the enabler in the BRR model, helping investors build long-term portfolios by recycling funds effectively. Second charge loans. So these are a really useful option when speed or flexibility is needed. If you've already got a mortgage in place, quite often, especially if you're one of the lucky few that got stuck on a tracker rate and was laughing when COVID came in and was stuck on a nice 1% rate, that was really great, and a lot of people didn't want to lose that. This is where second charge mortgages really come into play. So a second charge loan allows you to unlock equity without touching the first mortgage and losing that preferential rate. It can be ideal for raising capital for refurbishments, deposits on other property, business investments, or even lease extensions. It is also quicker than a full remortgage in many cases. So you can get second charge bridging and just a standard second charge term loan. Both of them, they're pretty much the same thing, except one gets repaid back within a year or so. The other one, you usually let it run until your first charge comes up to the end of its fixed rate duration, at which point you just amalgamate them and then refinance as one and get it done that way. So instead of refinancing the old loan, the second charge sits behind the first and it gives access to funds whilst keeping the original deal in place.
Can I just ask a quick question?
Yeah, of course you can.
So projects, and let's just say you're running out of money.
Yeah.
You've done it traditionally through a mortgage, and you think, right, you're going to flip it anyway.
Yep.
So you get a second charge loan. Would that affect anything in terms of reselling that?
No, you just have slightly less profit if obviously you've got a second charge applied to it. You tend to, as I say, a lot of people for deposits and things, if you, I don't always recommend it, but if you get stuck in a tough spot, you can put it on your residential, you can put it on another buy-to-let you've got in the background, so it doesn't have to be the security property. You can, as I say, effectively cross-charge if you need to.
Would I be right in saying that not all first charge mortgage holders will give you a second?
Yes, absolutely. And it's caused me issues before. So there are some nightmare lenders, usually more specialist ones, unfortunately. But so anyone that's getting buy-to-lets or things like that. A lot of your first charge residential mortgages, your Santanders, they will give consent. Some of them won't. So unfortunately, once again, that is where your brokers are going to come in handy. You can say to them, this is my first charge lender. Will this lender allow second charges? At that point, get them, you either have to request consent, but it's usually quite easy for us to find out whether or not they'll allow it. And as I say, if it's not that property, then you could potentially look at another one you can do. Perfect. So development finance. So this is obviously a little bit different in terms of development tends to be for your slightly bigger projects. The options vary significantly depending on the complexity and scope of the project. So you've got your light refurbishments. These typically involve cosmetic upgrades like painting, decorating, minor repairs. Your standard landlords that come into a property want to increase in value. You'll usually run a light refurbishment product. They're often at lower risk, shorter timelines, and you may still qualify for bridging loans, which are faster and more flexible than development. So once again, it is worth having a chat to see whether or not it falls into the bridging or development scope. The rates will once again start between 0.65 to 0.85, depending on LTV and the borrower profile as well.
So that's it again, sorry.
What was that, sorry?
So that's it again, not the interest again, sorry.
Sorry, the what bit?
That's
Oh, yeah, sorry. So development. So the rates will start between 0.65 to 0.85 per month. And it depends on loan to value and borrower profile. So for example, if you own your own residential, you're much more likely to have access to more lenders, or so you may have had the term A&L, which is your assets and liability statements. If you've got lots of property in the background or anything like that, you'll have a really strong borrower profile and you're more likely to borrow a little bit more money. If I talk too fast, please do tell me. I have been known to... Yeah. So, heavy refurbishments. So these involve structural work such as extensions, roof replacements, or significant internal alterations. These projects require more extensive funding and longer-term finance solutions due to the increased risk and complexities. Rates tend to range between 0.85% up to 1.1%. Which lenders often require detailed costings and planning approvals as well. And then you've got your ground-up developments. So this means building new properties from scratch. This is the most complex and capital-intensive type of project. It requires specialist development finance with tailored lending criteria, and rates usually fall between 6.5 to 9% annualized. It's one of the only times you'll see an annual rate within like this kind of finance. The development lenders do tend to annualize it often, and arrangement fees will tend to be between 1% and 2%. But understanding where a project falls on the spectrum helps determine the appropriate financing product, balancing speed, risk, and cost. So one of my favorites. I started doing commercial many years ago, and that's how I fell into very specialist types of finance. But they're more commonly used for business premises or investment properties. So unlike residential loans, these mortgages are assessed not just on property value, but on the borrower's business performance and the asset's income potential as well. Every lender has a very different appetite to what they'll lend on. For example, Lloyds will love a warehouse, anything industrial, anything like that, where they won't touch a pub. or say a nightclub or anything like that. So once again, it's really down to getting a broker that knows what lenders can assess which types of property. And as I say, it's not a one size fits all. Every lender will kind of have a different appetite to what they'll lend on. For investment commercial mortgages, lenders focus heavily on the property's ability to generate rental income. So alongside the borrower's financial health, it determines the loan terms. And an owner-occupied commercial mortgage, lenders use EBITDA, which is earnings before interest, taxes, depreciation, and amortization. So this provides a clearer picture of the borrower's operating profitability and cash flow available to cover loan repayments. So it'll be all based on your accounts. For anyone that has a limited company, when you scroll down to the bottom and you've got your profit and loss account, there's certain things you can take back out. So if you're buying your own premises and you're being charged rent, you take that back out, put it back into the calculation, you borrow some more. If you've got one-off costs, anything like that, your profit and loss account will be the key to what you can borrow on a commercial mortgage.
Sorry, Sharon, do you mind just explaining that again? Sorry.
Yeah, of course. So if you've got a limited company and you're going through, so say you're a window fitter or something like that, usually in your profit or loss, it will be leisure. So you'll go through your different things. It'll be rent, light, electrician work, anything like that. If there's any one-off costs or rent or anything like that, you can factor that back into the calculation. So you can actually borrow some more money because obviously you're not going to be charged rent anymore if you own the property, and there's certain things that you can add back into the calculation. It's a nightmare. You'll usually see me printing off a huge stack of accounts and going through all my highlighters and things. It's very taxing, but it evaluates the best way for you to borrow the most, and there's certain things you can, as I say, factor back in again. Yeah. Oh, lovely. So they evaluate the property value, rental income, EBITDA, and loan-to-value ratio to assess risk and loan size. Strong EBITDA combined with consistent rental income typically lends to more favourable interest rates and longer loan terms. Don't be surprised if you go and apply for a commercial mortgage and your broker sends you an email with just some headline terms and whatever else. You don't tend to get decision and principles for commercial mortgages. You don't tend to get a lovely bit of headed Word document or anything like that. Quite often we have to manually go to these commercial lenders and request the terms by basically selling the case to them. So if there's anything that you think is very beneficial about the property, try and sell the case, because that's the thing that a lot of these lenders will price on a case-by-case basis. So if you went and both applied for the same mortgage, but you had slightly different things that set you apart, you might likely get the preferential rate over the other gentleman, depending on obviously what you've advised them. So always, even if you don't think it's relevant, it's always worth to kind of selling the positivity on the commercial side of it as well.
Sorry, can I just have a quick question?
Of course you can.
It might be a stupid question. What is
None.
amortization?
Oh, hello. Well, so amortization. I wish I had some accounts so I could show you, to be honest with you. If I grab you at the end, I'll show you on a set of accounts, if that's okay. It'll just be a little bit easier for me to do it because it's a bit of a nightmare. It will be written as amortization on the account, and it's just another thing that you can add back in again for the rental for the calculations for affordability.
Thanks.
No worries. I knew someone was going to ask me. I should have thought about it.
Sorry. So the majority of the people who buy commercial stuff, is that through the pensions like David was saying earlier?
So that would be a SIP or a SAS, I'm assuming. Yes. So usually as your Barclays, your high street banks, you can only borrow up to 50% of your pension fund for the property. Oh, you're looking at it. That's why you're going to correct me then. But yeah, they're really beneficial. And to be honest with you, quite a lot of people are starting to tie up their portfolios in their SIPs or SASs now. So if that is anything that someone's looking to consider, once again, do find a commercial broker and they'll give you some good options for that basis.
So there is an increasing challenge on SASs because a lot of people have their commercial property that they trade from in their SAS.
Yep.
That was all well and good until Rachel decided in October that property asset is part of your inheritance tax liability.
Yep.
So you've now got an asset in a SAS you might have to pay inheritance tax on in 6 months from day to day.
Most people put them in there in the first place to avoid that.
Trading business, it's trading from the asset that you're in the SAS. So it's if you're looking to do pensions, you do need specialist advice. Is all I would say.
I didn't even pay him as well. Thank you so much. I appreciate that very much. Any more questions before I move on that side? Yes, please.
Back to what you mentioned about profit and loss.
Yes.
So on the profit and loss, so we've got 5 accounts.
Yep.
Previous year. And profit and loss, partners accounts year, current trading year. Proving profit and loss, would they accept like a zero printout? So we draw our accounts through that?
Would they accept a what, sorry?
A zero. So we do our accountancy through zero, you know.
Yeah.
So And that's got our, currently our profit and loss for this current year.
Yep.
That's not year end, we haven't filed them accounts. Are
Yep.
better than our previous year, which are
Yep.
filed accounts. How does that work? Can we
Well,
use-
over 3 years, so they'll factor in your affordable, so always get your 3 years worth of accounts, something like that, because they'll do an average over the 3.
So we're a new code. So last year was our first year of trading.
Okay.
That's our first filed account.
Yep.
Basically broke even. New
Okay.
We're a new code. So our second year of trading, we're a lot healthier than was our first year was, but they're not filed accounts.
What?
So do lenders take account of what we could produce from the
An accountant's reference. So if you know that you're going to go up another year, I would go to your accountant and get an accountant's reference. Not every lender will accept it, but obviously for companies that are starting out, that is a really beneficial thing. So Together Money is a really good lender that will accept an accountant's reference. So especially, so what commercial lenders don't want to see is decrease in profits. So even if there's quite a good reason, it's going to immediately get them questioning, okay, well, what's going to happen in the next year? So decrease in profits, no. An accountant's reference, it's just going to forecast exactly what the lender wants to see is going to happen from your books. And as long as I know a lot of people have got accountant friends, but try and make it as accurate as you can because you will get pulled up on it. But yeah, that's a really good way of being able to bolster up your affordability based on the 2 years accounts. Brilliant. Any more? Lovely. So choosing the right product. Choosing the right finance product is critical to the success of your project. Your project goals, timeline, and the condition or type of asset all play a major role in determining the best fit. Most importantly, always start with a clear exit strategy in mind. Knowing how and when you plan to repay the finance will guide which product is suitable. This approach helps you avoid costly mistakes and it ensures your finance aligns perfectly with your project needs. Once again, I know I keep banging on the whole broker drum. A lot of people, you can try and do this on your own, but 9 times out of 10, it's going to be a very costly, agonizing 8 months you'll spend doing it. And not only that, you might get halfway down the avenue and realize there was a slightly more cost-effective way of doing it, or just a less painful way of doing it in the grand scheme of things. So this is probably the thing that's going to really help you guys out, is what causes delays. It's incomplete documentation, valuation mismatches, and legal bottlenecks. Legal bottlenecks are the bane of my life at the minute. And something that, as I say, that's the one you're less likely to avoid, unfortunately, unless any of you are going to decide to be solicitors overnight and are really well versed in clauses and leases and all of the in-between of that. They are a nightmare. Please be prepared if you're going to go for a commercial mortgage. Sometimes you can get them done quite quickly. That is less likely, even if you're the best broker out there. Try and at least put about 6 to 8 months to one side. The advice being, we can potentially get it done in a lot less time than that, but if you're not prepared to go into that time span, I probably wouldn't bother with a commercial mortgage just because you'll be very disappointed. I see you nodding there, so you feel the pain. So delays in specialist finance deals typically arise from 3 issues, as I've just said. The incomplete documentation, so missing or inaccurate paperwork, it does slow down the underwriting and approval process. If you want it done, make sure that if you need a second pair of eyes to cast over what you've done, it's always worth sending it back. But hopefully your broker's got a really great admin team or is just really on the ball and they can look at everything for you. Second, valuation mismatches. This is a real bugbear, especially in my life at the moment. Unfortunately, I've had about 5 down valuations this week. If the property's valuation comes in lower than expected, the deal structure may need to be changed or renegotiated. Sometimes that can actually be of benefit. If you've said to your valuer out, you're trying to buy this property and they've gone, that's only worth 100K and he's got it up for a selling price of 150. Usually you can take your valuation report, slap it on the table and go, I want a reduction. So it's not always negative unless you're looking to fund your next project or if you're relying on being able to pull some money out, in which case that can be very, very painful for everyone involved. As I mentioned, the legal bottlenecks. Working with solicitors unfamiliar with specialist finance can stall the process. So if you find a good broker, I would usually ask them if they know a good solicitor that can handle the timeframes that you're going to give them. A lot of solicitors will go, yeah, that's absolutely fine, of course I can do it. They cannot, and you will be screaming into the phone most days if you decide to just use a standard kind of residential solicitor. A few other ones I won't go into too much, but just to kind of cover them for yourselves. Title issues are a big one that come up quite often. So restrictions or unregistered land can hold up legal checks. Something that's usually not within a huge amount of your control, to be honest with you. It will come up quite late in the process. You'll be waiting for your funds to be released and you're still waiting for these goddamn searches to come back. So they can be frustrating, but if you can sometimes get in front of them, obviously that will be hugely beneficial for you. Planning or building regulation problems, they can cause lenders to pause for extra due diligence as well. Complex ownership structures, so trusts, offshore companies, that can slow legal and compliance work down. They've got to make sure that you're not money laundering, you're not doing anything that you shouldn't be. Client inactivity or slow responses when providing documents or proof of funds often cause unavoidable delays, obviously. Surveyor or legal backlogs during busy times can extend timelines. That's why it is really, really crucial to find a solicitor that can do what you need them to do. And then AML, so your anti-money laundering, your KYC checks, they may take longer if there's an international element or unusual financial backgrounds. So that's if you just take the time, obviously if any of you are going to become brokers, to learn to know your clients. But if not, sometimes your brokers are going to ask you some questions. You think, why on earth is this relevant to my application? Don't get grumpy with them. They can't ask you anything that they can't put down onto their system because of your GDPR. Everything that they ask will be for the purpose of the application or their compliance. Lastly, if lenders have doubts about the exit strategy, they may require further assurances before approving the loan. How to avoid delays. So to avoid these delays that I've just gone through, prepare and submit all documentation early and accurately. Even if you're not into the legal process yet and you're still waiting for your offer, usually you can get most of your legal work teed up quite early on. So before you even get your offer, let your solicitor know, get everything running through, so as soon as that offer comes through to him, you can just plow through the legal process. Use experienced brokers and solicitors familiar with specialist finance. Conduct early title and planning permission checks. Cannot stress this enough. If there is anything that comes up, it's not usually fixable in the space of a couple of months. This will inevitably delay your projects for potentially months, years, if that. Be transparent about ownership structures up front. There's no point thinking, I don't really need to let them know about these shareholders. Everything always comes out the woodwork. And once again, if it doesn't for the first few months of the application, it definitely does just before the end when you think you've got away with it scot-free. And that will be the one time you sit there and think, I just wish I got that off my chest nice and early on. Communicate promptly and clearly with all parties involved. And schedule surveys and legal work proactively, especially during busy times. So if it's just on the run up to Christmas and you get to the first week of December, don't then start harassing your solicitor or your broker on maybe the 15th, because you won't get an answer until the following year and everything just slows down and dies. So yeah, if you've got any questions and things like that, summer holidays, Christmas, any kind of bank holidays, anything like that coming up, I would always try and get your questions and inquiries in before then. Get your documentation ready in advance, and always present a strong, clear exit strategy to give lenders confidence. So my final takeaways to give you all today: speed and strategy are key. Structure deals to suit your exit. Get advice nice and early on in the process, maybe even before you've gone to view the property. Some brokers might roll their eyes at you and think, oh God, I haven't even got a property, it's a waste of my time. No, it's best for everyone involved. You can crunch the numbers. If you get a broker that you get on quite well with, quite often they're not going to mind if they just call you up and go, right, I've got this property, what are you thinking term-wise in terms of this? You can give some advice nice and early on, and instead of them going out to view this property or yourselves going out to view it and thinking, oh, this is a great project, you've got some nice early on advice that might go, do you know what, that's not for me, that's not in my appetite. Specialist finance is a game changer. So to wrap this up, specialist finance opens doors many mainstream lenders can't, and used right, it will help you scale faster and smarter. There's no property types that you can't be assisted with. And as I say, it just depends on getting the right advice nice and early on. So if anyone has any questions, please do give me a shout. Yes. Oh, thank you.